All right. Top healthcare stocks for 2024, according to ChatGPT, of course, and wherever it's getting its information. I think it's supposed to link that. Maybe that's just Bing that does that. Anyway, starting off at number 1, J&J, Johnson & Johnson. So the overview, according to GPT, says a diversified healthcare giant with operations in pharmaceuticals, medical devices, and consumer health products. Why it's promising is because J&J has a strong pipeline of new drugs and a consistent track record of earnings growth. The company's size and diversification help mitigate risk, and it has a solid history of dividend payments. So that's cool, and a nice dividend rate, 3.4% as of July. No, as of May. May 20th. Very cool. And as we can see, it started in 1962. I think that's the oldest stock. No, we looked at one from the 1800s, right? Well, this is an old stock from 1962. It's been public since 1962. I mean, that speaks volumes to me, and kind of gives us an interesting view into the way the market looks. And you don't see this wild growth until the 90s. Early 2000s, and then after 2012, the end of the world, it just explodes here, which is really interesting. But let's not get ahead of ourselves today. Let's just get into the financials like we always do, starting with the income statement for the past 3 years, because I am not going to spend whatever cheese I need to per month to get all of that history. At some point, yeah, I think I will, but not yet. Total revenue has been around $80 billion each year. As you can see, it was a little bit lower in 2021, 2022, but it's right back up on top last year, and I think it might be making pace for the same. It's really hard to tell because unfortunately this is not 6 months or 7 months of revenue. It is the trailing 12 months, which is, I'm sure there's a good way to get some use out of that figure, but I just don't know what that is, and I'm not going to look it up right now. And their revenue to total expenses is pretty good. It looks like they have kept their total expenses approximately the same. I think it's kind of easy once you're up in the billions, the tens of billions, but man, I guess it depends on what you're spending on. And it looks like they're making the right moves. Their profit margin, or the total amount of revenue that they're making after all their expenses is about $20 billion per year if you look at these stats here, at least for the past 3 years, excluding this year, obviously. Yep. Over 20 billion. 24 last year, actually. 24 billion after total expenses. Alright. Let's look at their balance sheet. So their total assets, as we like to do, let's look at the cash. Has not been posted until the past 2 years. A lot of cash. I wish I had even 1/3 of that much. I mean, even less of that would be quite enough cash to do a lot of great things. $3 billion in cash, over $3 billion in cash for the past 2 years. Not sure what it is this year, but I imagine it's going to be the same unless we see something funky with their debts. And oh yeah, another thing we like to look at here is the operating expense. I'm going back to the income statement. I just want to see these salaries and wages. So that is interesting. I actually don't know what to make of that. Maybe I misunderstood what the salaries and wages is? Because I don't know how they're paying negative. I mean, it's not like people are working there and paying them to work for them. So that's strange. I don't know what to make of that. If anybody else does, please let me know. I am totally trying to get educated as much as possible on this stuff, and I'm willing to learn from anyone who is willing to teach me. Okay, so back here, the total assets riding between 160 and 180 billion dollars total assets, and the total debt far below that at 29 billion to 39 billion depending on the year. This past year, 29 billion. So they're doing pretty good, and their cash and cash equivalents could almost cover the entire debt each time. I mean, like at least 2/3 of it, it looks like. Well, okay, maybe not each year, but at least the past 2 years, no, the past year, it would have covered a lot of it, almost 2/3 of it. So that is a responsible looking company in my eyes. Makes sense as to why they've been around for so long, since 1962. Not sure there's a whole lot else that we can tell from this without me understanding more about what some of these other things mean, but it looks good. And I know we haven't been looking at the cash flows at all. It's actually not something I really know how to look into yet. I will try to do some research at a later point to understand that more. I guess we could look at it together right now. What is cash flow? Flow. And there are the fireworks. Here they go. Makes sense, 841. Cash flow is the net cash and cash equivalents transferred in and out of a company. Okay, so it's just how the money's changing hands. Something that'll be good to understand better, but we'll just keep it with the income statement and balance sheet for now. So, up at number 2, we have Pfizer, PFE, a leading pharmaceutical company known for its innovative drug development, including the COVID-19 vaccine and partnership with BioNTech. Why it's promising is because Pfizer has a strong pipeline of, that's redundant, the word pipeline, of new drugs and vaccines. The company's focus on biotechnology and mRNA technology positions it well for future growth. Additionally, its established revenue streams from existing drugs provide financial stability. So, they're making good use of products that have worked in the past, it sounds like. Plus, they're innovative. And this is freezing on me. We had this happen the other day. That really sucks. Alright, well, we might not be able to see the all here, but we could probably see it here. Yep, there it is. Wow, that is just great. I'm gonna just go back here, and we're gonna go here. Yep. Alright, we'll just go straight to the financials on that one. We had a good close. Up 26% today. Is that right? No, that's the Mac. Oh yeah, that is not today. That is from a while ago. Hold on. Let's look at the day. Okay, so, but not bad. And not too expensive. I mean, for a stock, I've seen some stocks hundreds or even thousands of dollars. And it does look like it has gone down from its high in 2021. Looks like that's where its highest high was, at $53. Yeah, historically highest. It's been around since 1984, July 31st, in fact. So about a month from now, that many years ago. 40 years ago. Wow. Okay, so the income statement. We've got 41 billion in 2020. They did really well in 2021 and very well in 2022. $100 billion in revenue, total revenue. Quite amazing. And their total expenses, they did decent. I mean, they were pushing it a bit, 2020, but not a whole lot. $8 billion and $9 billion difference between the cost and the revenue, so they were still coming out on top each year, and coming out on top by 40 billion. Okay, sorry, 37-ish billion in 2020. Seems like they're not doing as well as of last year. In fact, they are closer than they were in 2020 as far as total expense to revenue. 58 billion in revenue and 55 billion in expense. So if we look at their operating expense, and they don't have it, of course not. We gotta figure out a better way to find their employment records. But if I was a betting man, I would say if this continues, you know, and they probably have a good amount of cash, but I doubt they want to keep it this tight, their revenue to expense. I mean, 3 billion, that is getting pretty tight when you're in the billions of dollars. So they might start cutting back. They might have already started cutting back. Pfizer, new job postings. Well, I mean, they have new job postings. Don't know if job postings ever completely go away unless a business is really failing, though, so it's really hard to tell. And since we don't have that data here in the operating expense, we look at the operating expense, we can see it went up and up, but not by a lot. So they're keeping it tight, keeping it close to the belt. What was it? Whatever. Tight belt. They're keeping it tight. So not bad. And I bet we can see pretty responsible savings too if we look at this. So their total assets are more by a lot than their total debt per year, and they do carry decent amount of cash equivalents, and then their short-term investments, maybe they have CDs, maybe just stocks. I don't know if that counts as a short-term investment or not. Obviously after 1 year you get that better tax break if you sell. So 12 billion cash and cash equivalents in 2020, 31 billion in 2021, 22 billion in 2020, and 12 billion cash and cash equivalents in 2023. So they did do a sell-off of stuff of their cash and cash equivalents. I don't think they necessarily have just cash. Okay, that includes their short-term investments. I think we see that here in 22. Not really sure where that went, I guess. Okay. Cool. Alright, so, but it looks good. Their total debt did spike up a bunch last year. Not sure if we saw that in the income statement. Yeah, we kind of did, didn't we? Because we saw it getting tight. 3 billion. What was the difference instead of the average, or the larger gap between the revenue and expense of, 8 billion or more, much more in some cases, $37 billion. I think that was 2022. Maybe that's why they changed their little position here, their balance sheets, to less cash. Liabilities, which is good to know too. I mean, that gives you a lot of information. And they keep their receivables decent, and their inventory, they're not $11 billion worth of inventory is more than most of us will ever see in our lifetimes as far as personal inventory, but still, for a business that size, it makes sense. But yeah, the total debt, it went up a lot. I mean, they're keeping it between 34 and 38 billion between 2020 and 2022. Don't have a vision further back than that, but then they spiked about 40 billion up. Okay, let's say 36 billion, 35 billion up within a year. So they're probably trying to grow. Not sure what that looks like. Maybe they got some new innovative stuff going on. Maybe they're hiring more people. But the revenue didn't pay out then. But that makes sense. I mean, for it to just be that good in 1 year, it would be a pretty amazing turnaround. Although I'm sure there's a lot of operations managers that are able to do stuff like that. And you would hope that a company like this has at least one of those around, right? But yeah, it seems good. It seems pretty decent. Let's go to UnitedHealth Group Incorporated, UNH. Okay, so can we get to the all? Is it going to freeze on us? It's going to freeze on us. Alright, let's just go back. Look at it here. It's still freezing there. And we will, wow, okay, there's a college. Come on. This thing is not being nice. Okay. I don't know what's going on with Yahoo Finance, if they're just having some extra high amounts of traffic or what, but here we are. They started in, another 1984, October, so just 4 months after Pfizer. Same year. And they had some good spiking, and also the similar kind of, not a lot of expense until we get to even the late 90s. It was pretty moderate, and we just have this crazy spike up after 2012. It really was the end of the world, huh? Is that why inflation is just insane? No, I'm kidding. I have no idea, but wow, that's interesting. Okay, so here we are. Total revenue 257 billion, totally dwarfing Pfizer, right? I mean, they were in the tens, and Johnson & Johnson, because they weren't in the hundreds of billions of dollars. But what is their total expense? Okay, well, I guess, it pays to pay people, right? They're also pretty tight margin-wise, but it seems like they do keep it under the expenses, under the revenue each year, from what this is showing us. 257 billion in revenue, total revenue in 2020, and 234 billion in total expenses. So pretty good. Still so much money, but pretty good. And then last year, 371 billion in total revenue, 339 billion in total expenses. So they tend to keep those costs, what is that, 40-ish? No, okay, 30, around 30-ish. This one, yeah, about 30 billion. Yeah, and then that was a little tighter than normal, but they're keeping it between 20 and 30 billion. So that's how much they're making after total expenses. Not bad. Definitely more than Pfizer. So I imagine they have more cash to play with, at least more total assets. Depending on what they're doing with those assets, reinvesting or holding on to cash. So they're holding on to cash equivalents, 16 billion. So not a whole lot, which it's not a bad thing. I mean, you don't need a whole lot of that typically unless stuff really goes sideways. And they have a moderate debt of 40 billion to 60 billion, depending on the year. Last year was 60. So they're also slowly expanding up, or maybe that's just inflation, which is possible. That's what we saw with Pfizer too. It's kind of hard to tell, Depends on what things are inflating and what things aren't. Although I find it hard to imagine that most things aren't inflating. So the overview for UnitedHealth Group Incorporated, UNH. I just can't help saying it. That's what I don't know. It's just in my head. The largest healthcare company in the world by revenue. Yes. Okay. Wow. You know, that's a lot. I just kind of figured that might be something that had more revenue, but in healthcare, that is. But that's impressive. If that's accurate. ChatGPT is not always accurate, but not everything is always accurate. Gotta remind ourselves of that. Why it's promising. UnitedHealth Group's diverse business model, including insurance services and health services. So they have United Healthcare, which is the insurance services, and the health services is Optum. Provides a robust and resilient revenue stream. The company's continued expansion in healthcare services and technology makes it a strong player in the sector. Yeah, it's great. Hedging their bets, making sure that they're staying agile and not just sticking with, well, it worked in the past, which is also a great thing to do as long as you're looking ahead, right? Things change. Okay, so definitely big revenue there, you know, hundreds of billions per year in revenue, and a small amount of debt that they carry, which can be a good thing, and they're probably really quickly turning around that revenue and putting it into stuff, and a lot of it is these assets, whatever they are. A small amount of it is, I should start like just getting an Excel spreadsheet so we can just do these percentages, because I'm not very quick with math. Sorry. But yeah, small amount of their total assets are in these cash equivalents. Another small portion, I mean it all adds up, is in the receivables. So I think, if I remember correctly, receivables are things that they have yet to receive. What are receivables? Receivables are debts owed to a firm by its customers. Okay, yeah, so basically things that haven't been paid out to them yet, which isn't great. Obviously you want that money as soon as you can get it, but they will get that money unless the entities that owe that money default. That's how that works, I think. Okay, other current assets, whatever that is. I mean, that's just kind of nebulous. It doesn't give us a lot of information, but and what is this? Total current non-assets. Oh, you know what we forgot to look at? Their operating expense, which, again, I guess we just kind of have to look at the general operating expense, and we can see it's, you know, they're keeping it tight like the other healthcare entities are, which, depending on how you think of it, is good or bad. It means that the people who are working here are probably not seeing a lot more money, you know, as we're all getting hit with this. Yeah, I mean, it's a lot to unpack, right? I'm not going to try to get all personal about this. And the business has to stay afloat too, or else those jobs are going to be gone anyways. It's a delicate balance, this whole thing. Very delicate balance. It has increased though. It's not like it's stagnating. It's just probably based on the amount of people that are working there. No, anyways, that's a whole other thing, right? So these total assets, goodwill, and other intangibles, intangible assets, investments and advances. Interesting. But they have this whole total non-current assets that is the majority of their assets. Non-current assets. Okay, so, oh man, what is PPE? Net PPE. You know, I don't know if we've seen this. I think I just haven't dug into this before. Net plant property. Let's see what this has to say about it. PP&E, property, plant, and equipment. Okay, so it is the lease or the ownership of land, the facility, and the equipment, I'm guessing. Tangible capital asset shown on the balance sheet of a business and is issued to generate revenues and profits. So, I mean, it sounds like that's just stuff that they could sell off. I mean, obviously it's an asset, right? So they can sell it. And it's an income producing asset in a way. I think this might be the most literal way, in fact, besides human capital, which I don't, we're not seeing that here in the balance sheet. And we're not really seeing an income statement. We can guess at it. Okay, that's cool. Land and improvements, building improvements, machinery, furniture. So we're getting some ideas of what these are. And then there's stuff like goodwill and such, but that is the majority of their stuff. So really they're investing in the tools that make the things do the things, right? What produces the revenue. Object-wise, obviously the people are operating these things. And the debt, very moderate compared to the total assets. I mean, it's not even, it's not even half, obviously. It's not even, what is that, an eighth? Yeah, I mean, it's a very small amount. I feel really dumb. Okay, 197 divided by 26. Okay, yeah, it's about an eighth. 212 divided by 46. Oh, okay. I did net that. Okay, so I was looking at the wrong thing there. So that's okay. That's about a fourth. Is that right? Yeah. Okay. Yeah, that's right. A little bit more than a fourth. But still really good. I mean, not nearly anywhere close to the other debts that we were saying. So they're doing really good. Really, really good. Anyways, I think that's all I have for that. Interesting companies. Talk to y'all later.